Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Imagine your company is eyeing new horizons. Maybe launching operations in Brazil, setting up in Vietnam, or tapping into sub-Saharan Africa's booming fintech scene.
Yeah.
Sounds exciting, right? Full of potential.
It absolutely is.
Yeah.
And that potential, that growth is what draws so many companies in. And this is a big but from a finance perspective. Emerging markets are, well, a really unique mix.
A mix.
Yeah, of intense risks and, yes, substantial rewards. Navigating the financial side of things there, I mean, you've got unpredictable currencies, sudden regulatory changes. It demands way more than just good spreadsheets. It really requires adapting your whole financial approach. You need real adaptability, real foresight.
And that's exactly why we're doing this deep dive. Our mission today is to unpack those core challenges, yes, but also the opportunities in corporate finance within these very dynamic regions. We want to pull out the key insights from our sources and give you, the listener, a shortcut to getting properly informed on this really complex topic.
That's good.
Okay, so let's unpack this first. Before we get into the nitty-gritty of finance, what exactly is an emerging market? What defines them, really?
Well, you know, beyond the simple label, the key thing to grasp is their state of flux. Their economy's in transition. So yes, they're growing fast, often really fast,
Right.
but they're still developing key things like stable regulations, solid infrastructure, mature financial systems. It's that tension, huge potential rubbing up against foundations that are still settling. That's what defines them.
So we're talking places like India, Brazil, maybe Indonesia, Nigeria, Turkey. Those kinds of economies.
Exactly.
And they have this dual nature, like you said. Amazing growth potential, young populations, more people wanting to buy things.
Yeah, rising consumer demand.
Yeah.
Big opportunities there.
The flip side is higher volatility, maybe political instability, legal systems that aren't always predictable.
Precisely. It's a real balancing act. And connecting that back to corporate finance, that inherent dynamism means you face several core risk categories. And these aren't just footnotes. They demand a completely tailored approach. You can't just extend your existing models and hope for the best.
So let's break those risks down. When companies go into these markets, what's often the first big shock they feel? I imagine currency is high on the list.
Oh, absolutely. Currency risk. It's often front and center.
It sounds like a roller coaster.
It really can be.
Yeah.
Local currencies in these markets, extremely volatile sometimes. Imagine you're making money in, say, Mexican pesos, but your costs are mostly in US dollars.
Right.
A relatively small swing in the exchange rate, that can just decimate your profit margins, like overnight.
Wow.
So it's this constant financial tightrope you're walking. It needs very careful management.
And often going hand in hand with that volatility is regulatory uncertainty.
Exactly. That's the next big one, regulatory risk. You can suddenly face new policies, capital controls popping up, changes to foreign ownership limits.
Things that could just reshape the entire market.
Totally. Reshape it overnight, sometimes with very little warning. So companies need to be incredibly nimble, ready to pivot their strategy almost instantly.
And that sounds closely linked to political risk as well.
It often is. They're intertwined. Political risk covers everything from, snap elections and government instability to civil unrest.
Things that can disrupt operations.
Seriously disrupt operations, yeah. Halt supply chains, even cut off access to funding. It's a macro-level risk you absolutely have to factor into financial planning. Constantly.
Okay, so you manage the currency, you watch the politics and regulations. But then there's the challenge of just getting money right.
Yeah.
Liquidity constraints.
Yes, that's critical. Often overlooked until it bites. Local capital markets in many emerging economies are just underdeveloped.
Meaning it's hard to raise funds locally.
Very hard sometimes, whether it's for expansion or even just getting your profits back out, repatriating them to the home country. It affects everything, working capital, long-term investment plans.
And even deeper down, there can be issues with the numbers themselves. Accounting and transparency gaps.
That's another layer. You might find data quality isn't great, reporting standards are opaque, or maybe they haven't fully adopted international standards like IFRS or apply them differently.
The comparison's hard.
Incredibly complex, and it makes financial planning really tricky. So the deep insight here isn't just that emerging markets are different. It's that the really successful companies, they don't just adapt, they anticipate. They almost co-create the financial environment they work in, trying to turn that volatility into an edge.
That's a really powerful idea, reinventing your financial DNA, not just tweaking it. So let's make this real. Can we look at some examples? Companies that have actually faced these challenges and found ways through.
Absolutely. Let's take Coca-Cola in Nigeria. It's a huge dynamic market, but definitely volatile.
Okay. How do they manage?
Well, managing their exposure to the Nigerian naira is crucial. So they use hedging tools like forward contracts, basically locking in an exchange rate for the future. And they also use a mix of local pricing and USD-based pricing. Helps protect margins when the currency swings.
Interesting. What about Unilever in India? India's huge for them, right?
Massive. A major chunk of their global earnings. And India has complex regulations, so they navigate that using local subsidiaries, joint ventures.
Working with local structures?
Exactly. And their finance teams, they're doing scenario planning constantly because tax rules, pricing policies, they shift frequently. They have to anticipate.
That seems like a theme, anticipation.
Definitely. Look at Tesla in China.
Yeah.
Opening the Shanghai Gigafactory was huge. They're first outside the U.S.
Right. Big risks there, too.
Oh, yeah. Tariff risks, IP concerns, intense regulatory scrutiny. So what did their finance team do? They got clever. Onshore financing, costing things out in renminbi, building really strong relationships with local banks for working capital.
So embedding themselves locally, financially speaking.
Precisely. Or think about Nestlé in Brazil. Expanded aggressively, they hedge heavily against the real's volatility, sure, but they also invested big in local production.
Why local production?
Cuts down on import costs. So it's another way to buffer against currency risk and makes them more resilient locally.
And you mentioned banks, HSBC in Vietnam.
Yeah, another great example. They've really grown there by focusing on local currency lending. And crucially, they partnered strategically with the State Bank of Vietnam.
To navigate the rules.
Exactly. To navigate capital controls, foreign ownership rules. It shows how vital those local relationships are.
It's fascinating. What really stands out is how these huge global companies don't just apply a one-size-fits-all strategy.
No, they can't.
They tailor everything to the specific local situation. It shows it's not just knowing the risks exist, but actively, creatively managing them with very specific tactics. Financial innovation born from necessity, almost.
That's a great way to put it.
Okay, so we've seen the challenges, we've seen how some big players navigate them. But for you listening now, maybe in a finance team considering these markets, what are the concrete steps? The actionable strategies? How do you build that resilience?
That's the key question, isn't it? How do you build resilience proactively? Based on what we've seen, there are about 5 key strategies that really stand out. First, use hedging instruments.
We touched on Coca-Cola doing that.
Right. Things like currency swaps, forwards, options. Think of them like financial insurance against those wild currency swings. They protect your cash flows.
And you need to factor that into forecasts.
Absolutely critical. Build exchange rate sensitivity right into your P&L forecast from the start.
Okay, strategy 1, hedge. What's number 2?
Number 2 is adopt local capital structuring. Where it makes sense, try to raise debt in the local currency.
Why local?
Because it helps match your liabilities, what you owe to your revenues, what you earn in that same currency. Minimizes that FX mismatch risk we talked about.
Makes sense.
And also, consider hybrid structures, or maybe even getting guarantees from multilateral banks like the IFC or the EBRD.
Yeah.
They specialize in these markets and can offer backing.
Good tip. Okay, number 3.
Third, build flexible budgets. This isn't optional, it's essential. Use rolling forecasts, build scenario models.
With wide margins for error.
Exactly, wide tolerance bands. You have to plan for potential shocks. Supply chain hiccups, sudden regulatory delays, maybe rapid inflation hitting. You need budgets that can bend, not break.
Got it. Flexible budgeting. Number 4.
Fourth, you absolutely must monitor political and regulatory signals. And I mean in real time.
I'm not waiting for the news reports.
No way. You need active collaboration. Work closely with local legal counsel, with risk specialists. Track policy developments as they happen so you can react faster or even anticipate. Be ahead of the curve.
Okay, stay plugged in. And the 5th strategy.
Finally, and this is so important but sometimes overlooked, Invest in local finance talent. Get people on the ground.
Why is that so crucial?
Because they give you that real-time pulse of the market. They understand the local nuances. They can advise on tricky things like cash repatriation rules, optimize local tax structures, navigate compliance quirks, things an outsider might miss.
Local expertise.
Absolutely. At the end of the day, the finance team's job in these markets isn't just, making the numbers work. It's about building deep operational resilience into the whole financial model. It's about seeing the shocks coming before they hit.
Looking back at everything we've discussed, what really struck me was this recurring theme. The highest risks often seem to unlock the biggest rewards, but only if you approach it right. If there's one big takeaway, it feels like, yes, emerging markets can be high risk, definitely, but they're also potentially very high reward if you're strategic.
That is precisely it. If we distill it down to core strategic takeaways, first, don't just blindly apply your developed market assumptions. They often just don't fit.
Right.
Second, you must integrate those specific risk, political, currency, liquidity right into your financial models from day one. They're not afterthoughts.
Build them in.
Third, structure your financing, your capital investments specifically to withstand volatility, build in buffers, build in flexibility.
Okay.
And finally, use those tools, scenario planning, behavioral insights, to plan proactively. Don't just be reactive when things inevitably shift. In today's world, finance pros need to think globally, act locally, and build models that reflect that reality.
This has been incredibly insightful. This deep dive really gives you, our listener, a clear roadmap for understanding corporate finance in emerging markets. Hopefully it helps you get up to speed quickly on what is, let's face it, a complex but vital topic.
Definitely. And one final thought to leave you with.
Go for it.
What if we took this emerging market mindset, this constant anticipation of shocks, this embrace of flexibility, this proactive adaptation? What if we applied that mindset to all our financial contexts, even the ones that seem stable and familiar? How might that change your financial planning, your strategic thinking, right where you are now? Could parts of your own context benefit from that more globally aware, adaptable approach? Something to think about.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.